Warren Buffett is sitting on a staggering $325 billion in cash. Let that sink in. That's more liquid cash than the entire gross domestic product of countries like Finland or Ireland. Now, while some might interpret this as the legendary investor bracing for an economic Armageddon, the real story is far more strategic. This isn't just a mountain of money. It's a colossal arsenal of financial firepower, ready to be unleashed. Forget the doomsday predictions. The smart money knows Buffett's cash isn't about fear, it's about opportunity. So, what exactly is Warren Buffett waiting for? And how can understanding his dry powder strategy benefit you? Let's find out. So, $325 billion in cash. It has to mean Buffett's predicting a crash, right? That's the common narrative, but it's time to shatter that myth. You see, Berkshire Hathaway's cash pile has been growing steadily for years, not just in recent months. This isn't some knee-jerk reaction to current headlines. Take a look at this. Back in 2004 to 2007, Buffett's cash allocation was consistently above 20%. Then, the 2008 financial crisis hit. It seems like perfect timing, doesn't it? Except, when you dig deeper, you find his highest cash allocation during that period was actually way back in December 2004, 3 full years before the crisis began. What's more, he was already reducing his cash allocation in 2005 and 2006 before the recession hit. And if that doesn't convince you, consider this straight from the horse's mouth. Buffett has repeatedly stated he doesn't believe in timing the market. In his own words, he can't recall ever making an acquisition or turning one down based on macro factors. He's even said that he's not a fan of economics as a profession. So, if it's not about predicting crashes, what's the real story behind this mountain of cash? It's simple really. Warren Buffett is not a market timer. He's a value investor, and that's where his cash strategy truly shines. Let's talk about dry powder. It's a term you hear thrown around in financial circles. But what does it actually mean? Well, it has its roots in military history. Think back to the days of muskets and cannons. Soldiers had to keep their gunpowder dry, literally, to be ready for action. If it got wet, it was useless. In the investment world, dry powder is your financial ammunition, cash, ready to be deployed when the right opportunity strikes. And for Warren Buffett, it's a core principle of his value investing philosophy. He understands that market downturns, while painful for some, are a gold mine for those with the capital to take advantage. When fear grips the market and prices plummet, that's when Buffett, armed with his dry powder, can swoop in and buy great businesses at bargain basement prices. He doesn't need to predict the exact bottom. He just needs to be ready when the deals are too good to pass up. This is not about timing the market. It's about capitalizing on the market's mistiming. It's about having the financial flexibility to act decisively when others are panicking. It's about being greedy when others are fearful, as Buffett famously advises. Now, this isn't just some abstract concept. Buffett has put this into practice time and time again throughout his career. He views cash not as idle money, but as a strategic reserve, a coiled spring waiting to be unleashed. It's a source of immense optionality. It allows him to be patient, to wait for the fat pitch, as he calls it. He doesn't need to chase every opportunity. He can afford to be selective, to wait for the perfect combination of a great business at a great price. And this is a crucial distinction between Buffett and many other investors. They might feel pressure to be fully invested at all times, to chase returns even when valuations are stretched. Buffett, on the other hand, is perfectly comfortable holding large amounts of cash, knowing that it gives him a significant advantage in the long run. In fact, according to reports, a large portion of Berkshire's cash is held in short-term treasury bills, earning a decent return while remaining highly liquid. This is a way for them to generate a safe return on their cash, and that makes a lot of sense considering the high interest rate environment we are seeing today. This isn't idle money, it's a strategic asset, and in today's market, that dry powder is more important than ever. So, let's break down this $325 billion war chest. What does it tell us about Buffett's view of the current market? It paints a pretty clear picture. He's not finding many bargains out there. The research tells us that today's market is expensive, to say the least. The S&P 500's price-to-earnings ratio, a metric Buffett pays close attention to, is hovering at levels we haven't seen since the dot-com bubble. We're talking about valuations that are about as high as they've been in the last 40 years. And it's not just the S&P 500. Pretty much every sector across the board, financials, industrials, materials, they're all trading at historically expensive levels. Now remember, Buffett's philosophy is all about buying great businesses at cheap prices. And right now, those opportunities are few and far between. This isn't to say he thinks these businesses are bad, just that their current prices don't offer the margin of safety he demands. But here's the other side of the coin. While stocks are expensive, the yield you get for holding cash is actually pretty attractive right now. We're talking about the highest cash yields in the last 30 years. This makes cash an ideal investment for cautious investors in today's expensive market. In fact, this is also an integral part of the intelligent investor's philosophy. When the yield that you can expect from cash is higher than the yield that you can expect from holding stocks, the book suggests that investors should significantly decrease their allocation to stocks and increase their allocation to cash instead. And today, that's exactly the situation that we are in. In other words, cash is not just a safe haven, it's a legitimate investment alternative. So, Buffett's sitting on this mountain of cash, not because he's scared, but because he's being smart. He's following his own playbook, waiting for the market to offer up the kind of deals he can't refuse. He's demonstrating, once again, the power of patience and the importance of having that dry powder ready to go. Now, if you've read Warren Buffett's favorite book, The Intelligent Investor by Benjamin Graham, all of this probably sounds very familiar. Buffett's current cash strategy isn't some spur-of-the-moment decision. It's a direct reflection of the principles laid out in that book, which he calls by far the best book on investing ever written. See, Graham's philosophy, which Buffett wholeheartedly adopted, emphasizes the importance of value investing, buying assets for less than they're truly worth. And a key component of that is the concept of margin of safety. Think of it as a buffer, a cushion that protects you from errors in judgment or unexpected market fluctuations. In today's market, with valuations stretched thin, that margin of safety is hard to find. But cash, especially with its currently attractive yields, provides a different kind of margin of safety. It offers stability and optionality, allowing investors to weather potential storms and pounce on opportunities when they arise. This is precisely what Graham advocated for, a disciplined, rational approach to investing that prioritizes long-term value over short-term gains. He encouraged investors to be contrarian, to be wary of the crowd's enthusiasm, and to always have a portion of their portfolio in reserve. And that's exactly what we see Buffett doing today. He's not chasing the latest hot stock or trying to predict the market's next move. He's sticking to the principles he learned from Graham, principles that have guided him through decades of market cycles. He's demonstrating that cash is not a sign of weakness or indecision. It's a strategic asset, a powerful tool in the intelligent investor's arsenal. It's a testament to the enduring wisdom of value investing and the importance of having a long-term perspective. So, has Buffett's dry powder strategy actually worked in the past? Absolutely. Let's rewind to the 2008 financial crisis, a period etched in financial history. While the world was panicking and markets were in freefall, Buffett was calmly assessing the wreckage, his cash reserves ready to go. And boy, did he put that money to work. Remember, his cash allocation had been building up before the crisis hit, not as a reaction to it. This wasn't luck, it was preparation. During the depths of the crisis, Berkshire Hathaway made a series of incredibly shrewd investments. He provided critical capital to Goldman Sachs, a deal that netted Berkshire billions in profits. He injected $5 billion into the investment bank, securing preferred stock with a 10% dividend. He also invested heavily in Bank of America, another institution that was reeling from the crisis, again at incredibly favorable terms. These weren't just random bets. They were calculated moves, taking advantage of the fear and desperation that gripped the market. Buffett was able to secure terms that most investors could only dream of, all because he had the cash on hand to act decisively when others couldn't. And these are just two high-profile examples. Throughout the crisis and its aftermath, Berkshire made numerous other investments, picking up stakes in companies like General Electric and Swiss Re, always with that same value-driven approach. The 2008 crisis serves as a powerful case study, demonstrating the immense value of Buffett's dry powder strategy. It wasn't about predicting the crisis. It was about being prepared for it. It was about having the financial strength to not just survive the downturn, but to thrive in it. This historical precedent is crucial to understanding why Buffett's current cash position is so significant. It's not a sign of pessimism, it's a sign of readiness. It shows us, once again, that he is a value investor. So the big question remains, what is Buffett really waiting for? What kind of opportunity would compel him to unleash that $325 billion? Well, nobody can know for sure, not even Buffett himself. But we can make some educated guesses based on his past behavior and his investment philosophy. The most obvious scenario is a significant market correction. A broad-based decline in stock prices would create the kind of widespread undervaluation that Buffett craves. It would be like a Black Friday sale for the entire stock market, and you could bet he'd be ready to fill his shopping cart. Another possibility is that a specific company, one that meets his stringent criteria, becomes available at an attractive price. This could be due to a temporary setback, a shift in market sentiment, or even a broader economic downturn that disproportionately affects a particular sector. Remember, Buffett doesn't just buy stocks, he buys businesses. He's looking for companies with strong fundamentals, durable competitive advantages, and competent management teams, all at a price that offers a significant margin of safety. But here's the crucial point, Buffett isn't in a hurry. He's demonstrated time and again that he's willing to wait, for years if necessary, for the right opportunity to come along. He's not trying to catch every falling knife or jump on every bandwagon. He's playing the long game, and he knows that patience is one of his greatest assets. And this is a lesson that every investor can learn from. While we may not have billions at our disposal, the principle of having dry powder, a cash reserve to take advantage of market dislocations, is relevant at any scale. It's about being prepared, being disciplined, and being ready to act when the time is right. So, there you have it. Warren Buffett's $325 billion cash pile isn't a doomsday warning. It's not about market timing or predicting a crash. It's about opportunity. It's about having the financial firepower, the dry powder, to capitalize on market dislocations and buy great businesses at bargain prices. It's a testament to his unwavering commitment to value investing principles he learned from Benjamin Graham and has honed over a lifetime. It's a powerful reminder that cash, in the right hands, is not just a safe haven, it's a strategic weapon. Now, how can you apply the dry powder principle to your own investments, even on a smaller scale? How can you cultivate the patience and discipline to wait for the right opportunities? I want you to really think about how this principle of being prepared, of having that reserve, could change your investment approach. And if you are interested in investing, consider subscribing, liking this video, and watching my recent video, The Shocking Reality of Kim's Troops in Ukraine. It might give you a different perspective on global events that could impact your investment decisions. Until next time, remember the power of patience and the strategic advantage of having your own dry powder ready.